Article 10, paragraph 5. Right to tax dividend declared by a foreign company deriving income from other state. Now, before I actually get into the provisions here, let me just kind of show you a diagram. This is going to make things more clearer. Let's say, for example, there's a foreign company, okay? It derives income from India. Out of this income which it gets from India, it declares dividend. The issue which comes up is, would the source state have a right to impose tax on dividend declared by the foreign company out of income which has been derived from the source state? Right? Now let's read what is there in the Article 10, paragraph 5. Where a company which is a resident of a contracting state, which is F1 in our example, derives profit or income from the other contracting state, which is India. So if a foreign company derives profit from India, that other state, India, may not impose any tax on the dividends paid by the company. So if there are any dividend paid by F1, India will not have a right to tax such dividend, except insofar as such dividend are paid to a resident of that other state. Right? Let me just look at this example now. So in this example, what is happening is there's a foreign company which is paying dividend to B Co, which is a resident of source state. So if the dividend is paid by F1 to B Co, then the source state has a right to tax such dividend. But if the dividend is paid by the foreign company to another company X, which is not a resident of source state, but maybe it is a resident of a third country, right? Then the source state does not have any right to tax such dividend. First exception is if the person receiving the dividend is a resident of the source state, right? Or insofar as the holding in respect of which dividends are paid, right? So if the foreign company pays dividend on certain shares and that ownership or the holding of shares is effectively connected with a PE or a fixed base situated in that other state, right? Now let's look at an example for this one as well. So in this case, what is happening is there's a foreign company, right? It has a PE in the source state. If the dividend is effectively connected to the PE, which is there in the source state, then source state may have a right to tax such dividend. So while this is the general rule, this is an exception 1, this is exception 2. Now, what additionally source state can't do is nor subject the company's undistributed profits. So if F1 has certain undistributed profits, it cannot be subjected to tax on the company's undistributed profits, even if the dividend paid or the undistributed profits consist wholly or partly of the profits or income arising in such other state. Which means if this foreign company gets its entire income from India also, if it has some undistributed profit or it is declaring dividend out of those profit, the source state will not have a right to tax such dividend. So what this means is that if there are undistributed profits with F1, no tax on undistributed profits can be applied by the source state on such undistributed profits. Having said it, if F1 gets any dividend from the Indian company, it may have to pay tax on dividend in the source state on such case. Now there's an interesting clause in the India-Hungary Treaty in the protocol which says when the company paying the dividend is a resident of India, right? So let's say we have an Indian company which is a resident of India. The tax on distributed profits shall be deemed to be taxed in the hands of the shareholder. So if the Indian company pays some distribution tax, dividend distribution tax, this will be considered as a tax in the hands of the shareholders and it shall not exceed 10% of the gross amount of dividend. Right? So it's debatable, But if you actually interpret this, this says that the dividend distribution tax on such dividend should be 10% of the gross amount, right?